How's it going, guys? This is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, we're going to be talking about IPDA data range. We're going to go back throughout this year and look at a couple months that IPDA really shined forward and really produced really good setups and showing us where price is most likely going to target. Here, we're going back to March. This year, 2023, I had did a daily tracking for British pound versus US dollar. So if you go back on the channel and you watch those short 1 minute to 5 minute videos, you see me calling out the daily draw or the bullish or bearish trend of that month. So let's begin. So IPTA is just a tool to figure out where liquidity is most likely going to be residing on the higher time frame. So this tool on TradingView, I'm not sure how it works, but for some reason it's saying 28 days. I'm on the daily time frame. It's actually 20 days or 20 bars. So each one of these bars represents one day. I'm not including the weekends at all. So no Sundays. So we got 40 and we got 60. So just a refresher, what I'm looking for is buy side and sell side, and I'm looking for a purge and revert. I'm looking for price to take out one side of the liquidity pool and run to the other side of the liquidity pool. It's that simple, not too confusing. But every single month, I'm doing it this way because I'm anticipating a quarterly shift. I'm anticipating price to change directions, purge and revert. Purge and revert. That's the whole main idea of trying to get the markets to breathe and expand and move somewhere. You don't want to be trading in environments where the market is most likely going to move sideways. And there are filters and gauges to understand whether or not you're going to be in a market that's going to move sideways. But most times, most traders get caught up in that anyways, and they have to live with it and they have to move forward and try and expect the next month or the next pair that they're going to trade is going to give more range expansion. For example, this here, you can see for February 2023, GEU was sideways. That's not a good trading environment. It's unfortunate. There are definitely trading opportunities within this month, but generally you want to see months that trend and move because it's easier to catch a trending market than a market that's going to just gyrate back and forth. That's more carnage. We don't want that. At this point, we cast forward 20 days from the beginning of the month. The reason we cast forward 20 days is because every 20 days, the market's going to be chasing a new liquidity pool. Every 20 days. It's a very staple that I use in my trading, especially for swing trading or even medium to long term trading. Every 20 days, the market's going to be reaching for a new liquidity pool. Either that's buy side, sell side, or it's going to be accumulating, getting ready for another quarterly shift, engaging into a new month. So every month I'm going into, I'm looking back 60 days and finding the highest high and lowest low within each one of those 20-day quadrants. So we have the highest high here. So that's the 20-day. Got the highest high here. That's the 40-day. And then we got the highest high here, and that's the 60-day. If you do go back to the daily updates for this month of March, you see me explain all of this at the beginning. The first daily update, I explained exactly my thought process going into the month, and it played out exactly as I expected it because price is only going to do a handful of things. It's going to go to buy side, it's going to go to sell side, or it's going to accumulate buy side and sell side sentiment. That's it. Nothing more, nothing less. We got the 20-day low, the 40-day low, and we got the 60-day low. Now, many people may ask, "Oh, what about those lows that has already been violated?" It's still a significant low, whether or a significant high. It's an old high, old low. It's still a PDA rate that I would use because it's still significant in price. Because if it's a market that's going off of coded time and using previous data to project future data, it has to be using specific points and certain levels that it's going to respond around. And I tend to see a lot of reaction using these IPTA levels. At this point, I like to mark off the opening price. And I believe this month was seasonally bearish, but then it turned back into ending up bullish. But you'll see as I explain and break this down. So using these levels, I'm going to expect either a reaction to occur. So at the beginning of that monthly breakdown for March, I had showed a couple scenarios that would unfold. I said that if it was going to be bearish, odds are it's going to sweep some type of swing high and then go low. Now, it could be these relatively equal swing highs here as well, or it could have ran up to this 20-day high and then produce a short opportunity to the downside. or vice versa. It could have came down and did this and then run up to the upside, and you'll see exactly the results. And I spoke about that first daily update on the channel. When we play it forward, we can see price comes down and purges the sell side liquidity we have available. So it runs right through the 20-day low, even this recent swing low here, runs through that 20-day low, runs through that old 60-day low, and runs out that 40-day low. At this point, in my mind, I would have to wait to see whether or not price would want to give a reaction to go higher. It's ideal to be buying below the monthly opening price because it's discount. And this is the opening price for the month right here. So this is March opening price. No indicators needed to tell you where premium and discount is. If this is fair value, the start or the opening bid for the month, once price is right here, it's down here. There we go. Once price drops below it, you know you're cheaper. And it's always going to be ideal to you as the buyer. If you're going into this market thinking I should be buying, this is the best and perfect territory to be buying in because it's cheaper to you as the retail trader. We play it forward. We're going to see price make a swing low formation. So we create a swing low here. And we're just going to make this one a little thicker. We create a swing low formation. If it's going to be a bullish month, it's most likely going to form a swing low formation below the opening price. Look at any bullish month. I don't care what pair you're looking at, what asset class you're looking at. Look at how the month forms. If the month is going to be bullish, it's most likely going to create a swing low below the opening price or fair value of the month. It's going to go higher. It's going to create a bottom and you're going to see price trade higher. We can also see in this theory as well, we have our formula playing out. We have price breaking a swing high here. We can see price comes up, breaks a swing high, and we'll keep this in black. Price breaks a swing high. So that's caution to what? Bullish momentum coming in because it's the daily time frame. It's not that I'm looking on the 1 minute or the 5 minute. This is the daily time frame. Daily structure is being broken to the upside here. That is bullish momentum. The fact that a swing high is broken is significant on the daily time frame. At this point, in my mind, in my ideology and methodology of finding bullish trends, I need to see a swing high being broken. You can see a swing high is broken. After that, I need a higher swing low to complete that formation. So as price goes along, we can see price goes up. There's a fair value gap as well here. And we can see price creates a potential swing low formation here. It's not confirmed yet, but in theory, it is a swing low. Let me mark this off here. Keep it blue. This swing low is higher than this one. Odds are we could expect that price is most likely going to continue trending higher for the month. Now, many people may ask, but now we're above March's opening price and a premium. That is true. But if the market is going to trend, it's going to negate the fact that it's in a premium and most likely trend higher because it has an objective to go to higher prices. If the market's going to trend, just because it gets into a premium does not mean it calls for reason for it to ultimately sell. Because if that's the case, it would always teeter-tot back and forth around the open. It will never go anywhere. All markets would just sit like this. Buy, sell, buy, sell, buy, sell, buy, sell. It needs to trend because there's open float. There's larger orders pending above an older high or older low. You can see we have swing highs here as well. Many things here you can tell. We have the swing highs here that were broken. Here, we got one there. We have one that hasn't been broken yet. So we still have targets to the upside. We have projections. And most likely the swing lows are going to be protected because it's a bullish trend. If this bullish trend is really unfolding and it's going to hold true, it's most likely not going to run the sell stops. It's going to want to protect the sell stops. It's going to raid the buy stops that it's creating and the ones that have been created in the past, according to if the look back data range. We play it forward, you can see it continues to trend higher. And any down day that we get, we most likely can expect what? Buying to occur after the down days. And within 20 days, that's where we would have been left off at. And if we continue to play it forward into the new month, we could see it even gets up there to the 20-day look back high, the 40 and 60 equal highs as well. We also have our breaker. So price comes up, comes down, comes back up, and trades right back down into it. So you can see the last up close candle before the drop. Look at how price respects it. Price respects that last up close candle before the drop, and then price comes down, hits it, and then runs higher. There's a lot of other confluences in here as well. Like I said, we had that fair value gap. So if we take off this, we also have that busy here that was formed, that buy side imbalance, sell side inefficiency. Price trading into that and then running higher. Look at the sensitivity as well. Look at how it runs right back to March's opening price, right below it, hits it. It's a sensitive price point. It's an old price point, but it's still significant to the price in nature. Look at how it runs right to the opening price of the month, hits it. Another buying opportunity. It's a cheap opportunity to buy, and it runs higher. Looking at this bullish trend, you could see if buying after down days were the 2020 vision to finding profitability or just being successful or finding results in general, you would want to do that. Granted, this is hindsight now that I'm showing it here, but we've already decided and spoke about this as the month went by and we broke it down day by day. At the beginning of the month, if you go back and if you actually spend the time, you go back and watch that month of March, I at one point in time was bearish, and then I changed my stance back to bullish because that happens. You're not always going to get the trend right. I try to tell traders all the time, you try your best with all these other formulas and all these other ways to find daily bias or recognizing daily bias or weekly bias or monthly bias. At times you will be lost because you're going to get it wrong, but you need to be able to make that pivot and say, okay, I was wrong. It's not bearish anymore. I need to change my stance. It's actually bullish. Or I was wrong. It's not a bullish stance. It's a bearish stance. But you need to be able to pick up on those signs. It comes with experience and it comes with time. And if you watch that month, you see how I change my stance from being bearish to being bullish. When price got back up here, I was like, it's most likely going to be bullish. And as you can see, if you follow that bullish trend formula, it unfolds here as well. Swing high broken right here. Swing high broken, even here too, and here as well. And then a higher swing low presents itself. We got a higher swing low. And this is a lower swing low. All with that swing high being broken. Swing high broken. We'll just abbreviate it there. And price continues to trend higher. But all in all, you can see how the IPDA look back data ranges showed me areas or where the market is most likely going to trade to. Not every single month is it the same. Not every pair is it going to be the same. But the whole premise of it is anticipating a quarterly shift. We could see there was a quarterly shift. At one point in time, the market was what? Bearish. And it shifted itself. There was the shift. Went back up into being bullish again. Not all the time does it always perform to the way that I would like it to, because we have to be flexible as traders. Everybody wants their model to be 100% perfect. Everybody wants their theory to always be working 100% of the time. It's not the case. And it's a month by month basis too. When you have an edge for 1 month, it may not be the same edge you have going into the next month. That's something traders have to learn as they progress in their trading careers. 1 month is not the same as every other month. 1 week is not the same as every other week. 1 day is not the same as every other day. We know that there's differences in the data and the validity and the success rate in certain models depending on the time of season, geopolitical tensions, interest rates, inflation, and other things that impact the market. So hopefully this was insightful. This was March IPDA using British pound versus US dollar. Please go back and watch that whole daily breakdown during that month. I really give a good way in entailing how simple the approach of finding the daily draw is.